all. Thank you for joining us today. I have the honor of welcoming guest speaker EJDM Bryan Machacek. Bryan has over 20 years of experience working with business owners, assisting business strategies, accounting, and taxation needs. Bryan is also the director of MoneyWrench, which is a division of his firm that is dedicated towards providing business advisory and compliance services to Canadian auto shops and their owners, helping them to navigate the complexities of accounting, taxation, and business practices, and financial management, business systems, and leadership. Having large aspirations for your shop is a given, but along the way, you get stuck. Growing and sustaining that business is hard work, and if the revenue and profitability don't meet your expectations, then it can seem pretty meaningless. I am honored to host this conversation today to dive a little deeper into the 5 most common mistakes that Bryan and his firm see, review the implications of those mistakes, and go over some corrective tips. Little bit of housekeeping today. We are welcoming the Q&A, so you'll see it down at the bottom. Please feel free to submit questions to Bryan. If we can implement them throughout this session, we will. If not, we'll take care of them afterwards. We also have some really fun poll questions to engage you guys with. But Bryan, I am going to turn this over to you. And again, thank you for your time today.
Thank you, Amber. It's a pleasure to be here, and it is, you great introduction. I'll just say again, director of MoneyWrench here in my firm. We're accountants, but we focus on working, at least our MoneyWrench program focuses on working with auto shops and their owners to help build healthy auto shop businesses and help the owners succeed. So today we are going to be going over, I'll just go over the summary of our objectives, discussing the 5 common mistakes that we are going to talk about. We will understand the implications of these mistakes, provide corrective action and tips, polling questions throughout, and then a conclusion at the end with questions. So let's just get after it here. First mistake: your shop management software doesn't match your bookkeeping software. Now, as accountants, we love to use acronyms, so I wanted to just have some common language and lay that out for us here. SMS, or our shop management software. This is us, the program that we're using to run the front end, your service advisor, invoicing, technicians entering in hours, etc. The SMS. Books, that would be our accounting software in real time. And this is our back-end accounting software. Some programs will do both, not all of them. If you're using accounting software in real time, what we mean by that is really cloud-based accounting. I've got many clients that still run desktop versions of their accounting software. The cloud really helps the advisor, myself, work with the client because it provides me access in real time to that data. If I have a desktop version, the client needs to send that to me in a backup. It might take a few days to work out passwords because it changed. In the meantime, your bookkeeper's been pumping transactions into your desktop software. Now we're talking 2 different sets of books and different language and potential problems. So cloud-based real-time software. The other comment here is the portal. If you're working with a coach, there's likely a website or something where you are entering in your data through to the portal, and that's your coach. All right, so our first polling question: are you currently utilizing a desktop version for your accounting software?
Give it about 30 seconds. Super exciting. And then Bryan, I also wanted to kind of, while we're waiting for results, I know you and I spoke the other day, but with the desktop versions, right? If you are using that, or you're not really just utilizing your books to kind of use it for the accounting software, what implications do you see, and what should they be doing to make sure that they're not making that mistake? I think we discussed the integrations is really the most important thing in that aspect.
Yeah, so we'll talk about that here in the first mistake. But yeah, really, I think the biggest piece of a desktop version is just it can still work, but it provides me, it's harder for me to interact with my clients. Again, that transfer of data, a backup's got to come to me, we've got to restore it. We're now looking at potentially different sets of data. The cloud just allows me access to get onto the system at a moment's notice and see exactly what the client is seeing and doing.
Yeah, so it's really interesting. We saw over half of the audience is still using a desktop version.
Okay. Yeah, and there's people who are security and the cloud. There's a potential stigma about the cloud. I find from a physical standpoint, the cloud is much safer than your local server. If you have a fire, for instance, in your building and things burn down, if you haven't been backing up your software on that local system, it's gone now, your data's gone. So the cloud provides that safety and security, but there are reasons. And anyways, it's easier for us, I guess the point being, to work with our clients if they're in the cloud.
And I would imagine you're seeing, correct me if I'm wrong, but are you seeing a big change from desktop to cloud? I would imagine, what's the majority of your clients moving over?
Yeah. We're probably very similar to the poll results that you showed there. I was at some conferences with some players in the software and the cloud software. Australia and New Zealand were ahead of the curve. So they're running about 75-80%, as far as I understand from the data that I've read, cloud basis, versus North America. Here we have lagged a bit in that regard, but it's certainly come on. If I back up 10 years, I don't think we had one client on the cloud, and now we're sitting at about 60%. So
that's what we saw. That's super interesting.
Yeah.
Well, I think Australia is ahead of us in a lot of things. Food-wise too, their food industry is just so much better than at least in the States. A lot more cleaner.
All right, so mistake number one, your SMS doesn't equal your books. What are we talking about here? So shop owners, you're likely setting margin targets for your team to hit. The big ones being the labor and the parts margins. Could be tires, sublet, shop supplies, things of that nature. But you're likely setting margin targets. So what happens in the situation where your parts margin is at 50% in your SMS, but only 40% in books? Which one is correct? And we do see this quite frequently with new clients that onboard. Maybe they haven't looked at this before, or it's the first time they're hearing about it, but we're seeing discrepancies there. So SMS is, a lot of ways what you think is happening. It's the front end. Invoices are being done out of there, time's going in there. The books, however, are tracking every nickel and dime that's running through the shop. And in a lot of cases, the books might be done by the shop owner's spouse, or maybe a part-time bookkeeper, or maybe it's being done daily if the shop is large enough. But what I've found is that SMS or the front end software people using that aren't necessarily always talking with the back end accountant. And we get these discrepancies that come up. And variances generally mean that there's issues somewhere. Now, they don't necessarily mean that those issues are problematic in the sense that you're out dollars, but they could. For instance, on the labor side, what we typically tend to see is, say you paid a bonus to a technician. Well, that's going to be running through your books, but not necessarily through the SMS on a margin level. Now, does that indicate a problem? Not necessarily, but it will kick up a variance that I at least want to know as the shop owner. On the parts end, what we tend to see is parts not getting invoiced out. We also see, unfortunately, sometimes parts walking out the door. I've got a client right now, parts margin variances between his SMS and his accounting books. And we've started to exhaust these issues and look into things. And I said to him the other day, I said, maybe there's parts walking out the door. And he said, I was a little bit concerned about that. And so we haven't nailed that down yet, but we would have never known that really had we not been looking at these variances. And a 10% spread in margin, in this case, could mean thousands of lost dollars, depending on the situation. It also impacts, these margin discrepancies also impact your ability to pull the best from your coach. If you're using, your SMS margins to input into your portal, which most shop owners do. If those are out or incorrect, now you're providing incorrect data to your coach, and your coach is not able to help you in the best manner that they should be. So that could be lost dollars and time. So our tip here always is monthly review of your real-time books, and it doesn't have to be real-time books. The desktop systems do a wonderful job as well. But monthly review with investigation of non-trivial variances. And yeah, I do want to mention, if there's a discrepancy of 1 or 2 points here, we're not getting too hung up on that. It's never going to be perfect. But if you're talking about 7, 8, 9, 10 points of discrepancy, that's something that you should be looking into and at least figuring out what the reason for it is. And it might not be indicative of a real problem, just a variance discrepancy that you need to identify, but it could be indicative of a problem.
And as we mentioned earlier, for those that just joined, a big part of that is making sure that the integration goes well, right? Obviously upfront between your books and the SMS.
Yes.
Really help with that double inquiry.
Yes, for sure. Great point. We were talking about that the other day. A lot of the SMS softwares are integrating over with your accounting software, pulling invoices and things, so we don't need to double up. But you still want to be watching that and making sure that if there are discrepancies, you're understanding why that's there and taking the corrective action necessary. All right, mistake number 2, you don't look at your financials often or ever. So I threw this slide up here because, I've been in this longer than I probably want to admit. But I have heard these comments numerous times over the years. I can't stand reviewing financial information. I just want to get back under the hood. This is what I hired an accountant for. I'm not sure if you made those comments out there who are watching, but I have heard them certainly over the years and I can count on well more than multiple hands how many times I've heard these.
Well, definitely around tax season. I definitely say my accountant. I don't need to collect all this stuff. Yeah.
So you don't look at your financials often or ever. The truth is many people fear finances. We're not taught it in school. I know certainly up here in Canada, we're not taught it. I'm not sure down your way in public school and what have you, but we're not taught it up here. So it generally leads to a lack of knowledge and financial acumen across the broad spectrum of us here in North America. But ultimately, as a business owner, it's your business and and you need to take that responsibility and educate yourself. So some impacts that we see in the historical model of accounting, and I say historical or the traditional sense, it was, Amber, you might have been my client, or you might be my client, and you're running a year end of June. So your year end was a few months ago now, and you bring your books in, and I prepare the financial statements and tax returns, have you in for a meeting, we talk about some things. Oh, hey, your margins seem to be slipping, you're spending too much here or there. And then you send you on your way and we do it again next year. If we do that, that review is far too infrequent. I might have been saying you're spending too much on advertising. We like to see, 5% of your sales spent on advertising. That's a good number. And you're doing 12 and you're not getting those results. Well, some of this information we're looking at now is 12, 13, 14, 15 months old, and it's too late to take that corrective action. So this leads to poor decision making, or perhaps no decision made and potentially lost dollars to you. And ultimately, owners need to understand where it went right and or wrong. And this is particularly important when the owner is looking to scale back and perhaps move into a retirement mode, but still wants to own the shop. Your lifeline is going to be the financial statements. When you're at the shop on a day-to-day basis, you can feel and hear and see the blood, sweat, and tears going on. You understand how busy you are. If you're removed from that and you're not seeing that, it's the financial statements that are ultimately going to provide you and be indicative of how the business is doing. So, a common example being my sales are up last month, but my cash position is worse than ever. And why? And there could be many reasons for that. But ultimately, if I don't understand and I'm not following through a financial statement to be able to tell me where that is, I might be unable to take that corrective action. So take charge, review often, question always. There's the old saying, there's no dumb question. There really isn't. And work with a great accountant. And when I say great accountant, what we mean is somebody who is going to explain things, educate to you, tell you how much you made, where the money went, and how to keep more of that in your pocket and in your jeans. Ultimately, all of us in the accounting world, we've passed courses and we've got ethical obligations, and everybody's a competent accountant. Some are just better at business advisory than others.
So Bryan, just from this standpoint, right? Like, I think that this also leads back to the mistake number one, right? If things aren't syncing and you're not looking at it correctly, obviously you're going to have missing holes in there. But, to go back to the previous slide, and the quote that you hear often is like, this is what I hired an accountant for. Absolutely. But at the same time, this is your personal money. I mean, this is your personal business, and you should be involved in that and many aspects. But, how often should shop owners be looking at their statements?
Yeah. So in our MoneyWrench program, and the way we operate with our clients is we're providing a full suite of services across the year. So there's touch points going on throughout the year. We're doing your corporate taxes as a certain point in the year, your personal taxes at this point. We're doing annual strategy meetings with our clients. We're doing monthly reviews of the financial data and providing what we call our scorecard back to the client with discussion on those numbers and variances. And we're talking about these issues with regards to SMS and the books, as well as just where that margin is. So in that case, a lot of perhaps what a coach is doing from the numbers perspective, we don't get into it as deep as the coach will on the operational end. For sure, we're more financial based, but we're talking with our clients monthly. I've got a larger client, but it's weekly. So it's that communication that's regular, pulsing, is really what makes the best.
I mean, the example we said on the call the other day is, it's just like getting your car tuned up. You have those regular maintenances on your car, and it's the same thing. I mean, I know this sounds super simple and like, no crap, like, of course we should be doing this, but it is hard, especially when you don't, finances scare you. You don't know how to ask the right questions. Like, those are common things in any life experience, right? I mean, we could be on a call and I have no idea what you're talking about, and I would be scared to ask a question, but like, you have to do it.
Well, and it's why we love, accountants again, love to talk in acronyms, right? And why I kind of explained what we were talking about with SMS. Maybe it seems commonplace to me what SMS is, but especially in tax, there's a lot of acronyms that are thrown around that the person who is not educated in tax wouldn't know. So yes, that conversation routine is ideal for sure.
I think we even have a poll there.
Yes, we do. So the next poll question being, do you currently review your books with an advisor, on a monthly or quarterly basis, or some form of frequency?
So this does denote monthly, everybody that's on the call, but just a frequent review with an advisor is kind of what we're getting at here.
Yes.
I'm going to give it another second. Really interesting. Actually, we're seeing a majority of people are saying no. So about 77% of those on a call are saying no. So, I know we've kind of reviewed what those implications would be, but really honing in on those and what that looks like, come end of year, you could be missing so many different things in your books.
Yeah, exactly.
And the shuffle is, on top of the stress that shop owners already have running daily operations, this just adds to it tenfold. So,
yeah, absolutely. We do. It is tough. I do find in working with shop owners that, especially ones that are in the business on a day-to-day basis, it's tough to find a few minutes to even have a chat in some cases. But it is ultimately a much more beneficial relationship when I can see the clients that we work with on a more frequent basis than the ones that are the more traditional model, for sure.
Well, and over time too, I don't know, time is money, right, for everyone. So like these monthly and quarterly sit downs, the more frequent they are, the quicker I'm sure that they go, right? Because you're more in tuned with all of the things that are going on. So I
Yeah,
would imagine, it's just like anything, starting a process, starting a plan, you have to put in the footwork to begin with, but over time, those conversations get easier. You become more aware of what's going on. So
yeah, correct. All right, well, we'll move on to mistake 3. You aren't paying yourself properly. So, the beauty of being a business owner is you can set your salary, and if you own the building and the land and building that the shop is operating out of, you renting it to yourself, an extra stream of income. But it's easy to overlook the needs of the business and yourself, and you need to ultimately find that right mix that works. Implications of not doing this, on a fair and reasonable manner is that, especially on the wage end, you could be at risk with tax authorities. We're not U.S. tax advisors at all, but I am aware of certain rules that require fair and reasonable compensation. So you want to be making sure that you're not running yourself at risk with tax authorities. If you're not paying yourself not paying yourself a solid salary or a low salary, means you're lacking Social Security and Canada pension, retirement benefits. Now, we could probably have a webinar in and of itself debating the merits of Social Security and Canada pension, but that's not what we're here for. What we're basically just saying is that, your retirement and planning that retirement needs to take into consideration many factors. You want to be working with your financial advisors on that. But by no wages or low wages, you're not getting anything in there. Low or no rent could potentially cause problems with overstating net profitability of the business or creating future sale issues. For instance, if I owned my land and building in a separate holding company outside of the shop and I was renting it, maybe I've got a mortgage and I want to have the cash flow to finance that mortgage as well as the property taxes and utilities. So I set my rent at that level to do that. But if I don't have a mortgage, and just the property taxes and utilities, perhaps I'm just setting that rent to cover those. And the problem being that if we're not doing the fair value, if I get looking out to perhaps sell the business and a future purchaser is going, okay, I don't have the money to buy your building, or maybe I want to retain the building as a passive income stream. I'm sitting here going, well, okay, Amber, I'm going to jack your rents now. My books show $500 a month rent, but actually that is really $4,500 a month in the true marketplace. So, there's an extra $4,000 a month that you're sitting there looking at going, well, that's a lot of money over a year. And how do I do that? Right. So low or no rent can overstate net profit. And conversely, if we're paying too much, it puts unnecessary strain on the business and doesn't show that true picture.
Right. If people aren't currently doing this, right, like what would you say is a good time frame to kind of get things back on track? Does that look like a year, 6 months? Like, do you see this off?
Yeah, I think it probably depends on where you're at in your life cycle, if you will. Like if I'm a new shop, if I'm a new shop owner and cash is maybe tight, and I can't afford to actually pay that market value rent, if you will, maybe I want to gradually do that over. But if I'm a couple of years from my potential sale of business and looking to exit, I want to be doing that right away because I want to be showing a good couple of solid years of sustainable profitability at the right numbers. So that it depends. That's the classic answer. It depends, but it really could be a number of things depending on the situation. Yeah. So the tip here is, plan your pay annually. With our clients, we're always doing, we call pay yourself plan. So we're looking at things. We're looking at what matters to them in terms of, Social Security or CPP, other deductions that they might have. Maybe they're making large charitable donations and they're getting some good tax credits there. But we want to work annually and considering all the business and personal needs to determine what we're paying ourselves. Okay, mistake number 4 is you're treating your business cash as if it's a personal bank account. So let's just walk through a little bit of a scenario here. I'm not sure is this you or not. You need some money for something personal. Maybe you want to take the family on a vacation to Maui or something. You don't have that money in your bank account, but your shop does. So you draw some funds from the shop. Oh, geez, that was easy. Now I need a new TV, or my boy needs a new motorbike, new dirt bike. And we do it again and again and again, and then all of a sudden we get to the end of the year and the dreaded accountant tax man shows up. Certainly in Canada, there's rules that require us to repay any loans that we've taken from our corporations by certain timelines, so that can run us into trouble. But there's by just drawing excess funds out of our corporation outside of our remuneration plan can get us into trouble. So I don't know if this is going on. What we tend to see is this is more of a problem for those new business owners, because they're new to this. They don't fully understand. The more seasoned veterans out there have maybe experienced this in the past and the pain of doing this, and they realize that you don't want to do this.
Yeah. Go ahead.
Sorry, go ahead.
I was going to make a joke about the skeleton at the bottom, but I'll hold it for later.
Yeah, so mistake number 4, you treat business cash as if it's personal. Owning the business gives you access to all of its assets, by and large in general, whether that's owned personally or through a corporation. And it's very tempting to dip into the corporate bank account. We all have lives that are going on that require mortgage payments and vehicle payments, and wanting to take a vacation here or there, and things becoming more expensive recently here with inflation and what have you. You do really need to draw a line in the sand, however, is really the point here. Mixing business and personal creates administrative headaches. I've been in this for, again, longer than I want to admit, and I've seen the horror stories of people mixing business and personal back and forth. It can be a nightmare, and it's frustrating, and it adds up professional fees because we're trying to sift through every little expense. And it's costly to clean up that mess, and it causes grief and just stress. Whenever cash is drawn from the business, it reduces our ability to make a return on that. So we have a return on our assets that we employ in our business, and if we remove assets, we remove cash, we remove that ability to make that return. Maybe if we put that money into some extra advertising, it might drum up sales. Those types of things. It can create the problems with the tax authorities, like I talked about earlier. Ultimately, it can overextend you where you live above your means. So maybe you're setting your salary at $65,000 a year, just to throw out a number, but I drew out an extra $30,000 because my wife and kids wanted a new holiday trailer. Well, that 30, I'm now on $95,000 a year, and the business and it really should maybe be at that 65. So we want to be extracting the profits. We want good, healthy businesses, but we want to be extracting those profits as dividend distributions and distributions of profits, not through loans and such. So that's really the tip here is, keep that personal life out of the shop with discipline and stick to a pay plan. And I know that's tough and easier said than done in a lot of cases, but it really is going to help you overall run that better, more solid auto shop. So we do have another poll question. Do you draw funds from your business outside of your planned pay and salary, wages, and rent or rents?
While we're waiting for those to come in, I know we've had a few questions regarding these slides. So Bryan, first, this has been super helpful. So thank you for your time in doing this. Slides and recording will be sent out tomorrow. So everyone on the call will get those. So just be on the lookout for that. So thank you all for that. So we are going to give it another second. So again, we're seeing majority, I'm going to close that. Majority of people, well, I'd closed it before, but it was 60%. So now we're looking at 55% of people that are on the call do pool. So a little bit kind of like in between on both of them, which,
Yeah, and it certainly does happen. you want to avoid the horror stories, that's for sure, and where things pile up. And it's we talked about it the other day, Amber. It's like a snowball. It starts rolling down the hill and it starts getting bigger and bigger, and then it turns into this avalanche over years when you continuously do that, right? It's being cognizant of what you're doing. Yes, these are your assets, but you really need to be taking into consideration what is all going on, the needs of the shop, yourself personally, in order to do the best for both.
We do actually have another question, and I think that's anything in life too, right? It's super hard. Things are just that trickle effect, right? I'm going to spend this, use my credit card, but then at the end of the month, I mean, it's the same concept. So, but we did have a question from Tim. What about putting your business money in an interest-bearing account?
Yeah, if you've got excess funds, certainly by any means, if you're sitting there with excess funds in the business, and they're not really needed for how you're running the business, having that money sitting inside and earning investment income inside the business is great. In Canada, again, from a Canadian perspective, I'm not sure the US rules, but what we do want to watch for in Canada would be making sure that we're not running ourselves afoul of accumulating too much investment income inside the company, because that can throw us offside for potential tax savings down the road. But I always look at it and go, I'd rather have a dollar earning me something than just sitting in a bank account doing nothing, right? So yes, by all means, I would generally advise to do things like that if you've got surplus cash and you might not need to extract it personally. But be cognizant of what potential ramifications there might be on that from a primarily tax point of view. All right. Mistake 5, our final mistake here, you aren't planning your wealth transfer effectively. Again, we get to our common language, EBITDA. You may have heard of this before. Again, our funny acronyms that us accountants love. Earnings before interest, taxes, depreciation, and amortization. So ineffective wealth transfer. What we're really getting at here is the shop going to be your retirement? And it sounds like a silly question. The answer is likely yes, or a good chunk of our retirement. Shops are typically sold for a multiple of EBITDA. So what that means is we're stripping out all of the non-required expenses, if you will, the excess salary and remuneration that's over and above what Bryan might actually be paying somebody else to run the business. So I'm paying myself $85,000, but I'd really be paying an arm's length general manager $65,000 to run the business. We normalize all of that and we say, okay, a multiple of that is what the shop is going to sell for. And that is, in a lot of cases, not enough to carry us through 25 years of retirement. So we need to be doing other things. And planning for retirement and sale, again, we talked about it before, Amber, about how quickly time flies. And, decades go by, seem like in a blink of an eye, and you think, I got a lot of time to plan for this. And all of a sudden you wake up and you're 55 years old and you're going, I haven't put any money aside, or I haven't set the business up for a solid transfer to maybe a child or a sale to an arm's length party. So yeah, the shop likely won't sustain the retirement, is depending on how long your retirement is, etc. If that's all it is, so you need something else. Purchasers don't really generally want to buy a job. If I'm buying a business, I don't want to really buy a job. I mean, sometimes it certainly does happen. I want to buy a business that is going to make a return and a profit on my investment, and not require me to be there 15 hours a day. So owners need to build the shop so that it can run without them ultimately. In our own business, my own business as well, it's the same things as the accountants. A lot of our earnings are built off the backs and the hours that we put in. But ultimately, to run a good, solid business, Bryan needs to be working on the business, not in the business. And it's a similar thing here as well. The shop owner needs to build those processes and systems so that it can run without you, ideally, so that it's more desirable to a potential purchaser. Well,
and that's too, where SMSs do come into play of having something that is all-in-one, intuitive, and all of those things, but where you can really, going back to mistake one, like, you set yourself up for success and it's just running on its own, like automatically, all the systems. And that way you can focus on the financial aspect of the business,
Right.
And so it really all connects back to each other.
Yeah, for sure. You want to have your finances in order well in advance of a possible sale. If I sit here and I go, I'm about 8 years away, I think, I really need to be working on getting those systems and processes in place so that when 8 years rolls around down the road, I've got a financial statement that looks solid and sound and is sustainable, and that business that I can literally, extract myself and a new person comes in and it just keeps running smoothly. If I'm buried in the day-to-day, the new purchaser is going to go, well, I'm going to need to replace you, Bryan, and a lot of this is built off your back and your sweat. It's going to be hard, potentially. And then tax-deferred retirement plans. Again, we're not here to debate financial advisory, and that's not ultimately what I do. But tax-deferred retirement plans are a great way to gain a taxable deduction right out of the gate by making a contribution, and then those amounts will grow tax-deferred until I take them down. We've got similar programs on both sides of the border. And so looking at other ways to complement our retirement rather than just the sale of the business. So the tip, contribute to your retirement accounts early and often. Build your systems and processes to allow the shop to work without you. I think that's really the dream that we all had by getting into a business, is that we didn't want to be busting ourselves and working a 12-hour day. We wanted to have something that was going to help us grow and contribute to our families and give us that life that we always wanted. A couple more poll questions here now that we're through. Have you set up processes and procedures so that your shop can run successfully without you?
A few more. Oh. All right, give it another second. We're kind of like split down the middle. I mean, right, almost 50-50, but we're a little bit more, we see a little yes, but 56 of the audience is saying no. So,
I can tell you in my experience in doing this for my own business here, it's not, you just don't wake up one morning and say, I'm going to implement all these great systems, and it takes time and it takes effort. And there are some, trials and tribulations along the way when you're getting those things in place. But ultimately, that's needed to run that sound business where I'm not, contributing 14-hour days, and I'm able to spend time with my family and my children. Again, what we always are after here as business owners in the dream.
So with like over, almost 60% of people saying no, what would be the first two things, right, for a shop owner to do? What processes or procedures would you suggest or recommend that they start? The first two important things.
Well, yeah, I would think you really, there's many things that need to run a good, solid business. But, it could be processes, it's data, it's the vision of the business, it's, all those things need to come together. And I think one of the things that's, by and large, some of the easiest to implement quickly is that data component. Good, solid data that you can rely on to make those good decisions. You shouldn't be running your shop with just looking at your bank account going, well, I guess there's some money in there, so we must be doing good. You've got to be fully understanding the data and having your systems talking and aligning and giving you the good solid number and working with somebody who can help you. So that's what I would say would be one of the first things. And then, employing a coach, employing an actual coach to help you operationally. There's lots to a shop, HR issues, you name it, it just goes down. So you do need help. We're not experts in everything. We're experts in a few things, and we're relatively decent in others. So get that help in those other areas to help you round that business out and build it. There's a lot to it, but if you can get to that point and you've built that up, that's when you really see the fruits of your labor, as opposed to the frustration.
Yeah, a true sounding board. Start with that sounding board.
Yeah.
Mm-hmm.
And again, it might be some dollars spent. Certainly, if you're going to employ an accountant who's going to work with you more so than just once a year, it's going to be more costly, but that investment is going to pay dividends. Same thing with your coach. The final poll question, do you currently have tax-deferred savings to complement your retirement plans? I can say for myself, I did that as a young guy. I got into it, and again, you want to do this as early as possible, but for the power of time and compounding. But life did hit me. I've got 3 children, 9, 7, and 5, and that just it introduces a whole nother complexity to the mix of
100%. And seasons, right? So there may be times, like seasons of your life, where you've put money towards your retirement, and other seasons where you can't, and that is the same. It's a fluctuation, and I would say that's, going back to making sure that you're paying yourself correctly, and all of those things line up to the end of this. Like, we don't know the unknowns that we don't know, right? And things are always going to pop up. So
definitely.
We feel about 70% of the audience is not currently putting.
So again, I'm not sure if those people are working with advisors, and perhaps they're utilizing other vehicles for savings, or maybe the shop or the income isn't sufficient to allow me to do that. But it is certainly something that's recommended from the tax point of view. At least I get a deduction today that allows me to invest on a tax deferred basis for years from now. That is a great way, and that's why the governments have put those vehicles in place. And again, I'm not saying that's exactly what you do. You do need to be working with your actual financial advisor, an investment advisor, but it is certainly something that we always will recommend, at least to our clients, for sure.
So here's
sorry.
No, I was just going to make sure we open it up. So I know we've had a few questions come through, but while Bryan's going to go over the growth tips, just if you have any questions, continue to put them through.
Yes. So just in summary, the tips and whatnot that we talked about, having real-time data. Again, that's largely the cloud. Maybe there's some apprehension to move to the cloud, but it does allow your advisor, your accountant, to work with you, see what you're seeing instantaneously, and it's going to make for a better overall relationship, and as well as more meaningful, fruitful conversations and better results for you, and allow you to react quicker. Understanding your finances, if you have questions, ask them. You need to be bolstering your financial acumen. Aligning your business tools, like we talked about with the SMS and the books. You need to be doing that, and because that could be indicative of problems and actual things that are costing you dollars. Paying yourself what you're worth. Not always easy, especially early on in the business, in the shop's lifespan. But getting to that point where you're paying fair and equitable remuneration to yourself for what you contribute is going to set yourself up for down the road when you're trying to look to sell that business. Contributing to your retirement as early as possible where you can. The power of time and compounding is the point there. Planning that salary and remuneration as early as possible. Again, we work with our clients for that annual remuneration plans, salary plans, rent plans. What you don't want to do is just be drawn out of the business, and then at the year end, we got to try to figure out how to report that from a personal tax perspective. Watch your bottom line. You always want to do that. In my experience, I can tell you at times, when things have got hectic, I've maybe taken my finger off the finances a little bit, and then you go, oh jeepers, I should have been watching more closely because we were spending too much here or there, or we had unnecessary expenses. It's very easy for you to use that credit card and get into a regular monthly subscription, and then realize after 3 years that you've been paying Netflix and Prime and all these things and going, I'm not using any of them, yet I'm spending $100 a month or whatever it is, and I'm getting no benefit of it. So watching that bottom line. giving yourself the time to set the business up for sale. It's going to happen eventually. You don't want to be trying to posture this knowing that it's October 14th today and I got to have this done by December 31st. That's not going to be enough time. I need to be thinking years ahead in terms of getting things ready for that. So that was a bit of a summary of what we had discussed in the tips across the webinar today. And yeah, that kind of ends what we're here talking about. Thanks for watching.
Yeah, hey Bryan, we did have one more question come in from Jennifer. So do you recommend a preferred bookkeeping? I know like it may be different from US, Canada. Do you prefer one over the other, or can you recommend one for the real-time version instead of desktop? So like QuickBooks.
I will say that the majority of our clients that are in the cloud use QuickBooks.
Ours too.
Yeah, and I think they are the biggest player out there. Now there's some other players coming on hard. Xero is one. I think, there's pros and cons to each. Each has their quirks. Each has their nuances. Some do some things better than others. I think if you've got a bookkeeper that you're already, employing, or a part-time bookkeeper or whatever, really the key is ensuring that a switch to the cloud isn't going to frustrate the daylights out of that person. That person needs to be willing to do it and willing to learn, because there are some things I know, debits and credits and how a balance sheet should flow, but I don't necessarily know all the intricacies of how to make a payment go away in QuickBooks, and I rely on my team for that, because there is some learning to it. So again, QuickBooks online is the biggest player out there, and the majority of our clients run that one, but it isn't the only one. My most familiar would be that program. So
yeah, and yeah, that's really interesting, and that's what we see too. Majority of the AutoLeap clients are using QuickBooks as well.
Going back to what you mentioned earlier, though, with the SMS and the integrations, that is one thing. Like, we don't want to be doubling up, putting stuff into the SMS program and then having to re-enter it in. That's just, we want to be utilizing those automations and making sure they're getting that data to the right places with as minimal double entry as possible. But I do know, we do work with clients that run an SMS that doesn't integrate with, the system, and the bookkeeper is entering every single invoice again. There are services and providers out there that will help align and integrate these systems. So you want to make sure that's another point, making sure if you're going to make a move to a cloud-based accounting system, that it is going to integrate well with your shop management software.
Yeah, I know for us in particular, and we do that, right? The integration of QuickBooks, we pull that completely over, and our standard is, we pull 2 to 3 years of data from QuickBooks over, so that information and that data is there, and that's a really good sound time frame to have that, right? Because anything after that, all those invoices and everything, so it is, the integration is very important to make sure that your data is coming over, right? Because ultimately that is the soundboard for your business, so that's a huge piece of that.
Yeah, definitely. And we had mentioned it, do you have to go to the cloud? No. It definitely makes it easier to interact with the advisor, as well as to get those integrations. Although there are desktop systems that can do that as well. But that's the way the world is going. 2021 here, it's moving to a more digital, cloud-based society, and is it required? No, but it will help and make for a better overall.
Well, and it proves human error, right? Like, you and I talked about this, and I think you mentioned it in the beginning, but like, you and I could be working on the same document, right? And we're saving it to our servers, and you could have made 10 different, updates to that invoice or whatever we're working on, those books, and so everything is not synced. So yes, there is security, involved in that, but
it's always on my mind whenever a client sends me a backup out of desktop. what transactions have they posted since they sent me that backup? Because if I'm doing a tax estimate, for instance, on this backup, well, it's not showing the extra 20 grand of income that the bookkeeper posted, a week after they sent it or what have you, and we run into those problems. For sure.
Well, and
so I'm always leery about that, for sure.
Yeah.
Whereas that with the cloud, that is totally gone.
Yeah. We do have one more question, so I want to answer one more before we turn this off. And Bryan, you guys can reach out to Bryan's email. You can reach out to me at AutoLeap, and we'd be happy to get you guys these questions that we haven't been able to answer. But the last question from David is, working specifically with auto repair shops, do you see general ratios, industry specific, such as sales per host or gross profit percentage, that would be good targets for the shops to hit?
Yeah, definitely. There are certain margins that we advise our clients to try to strive for and set those targets for. We primarily work on higher level, larger margins, so the labor margins, the parts margins. You're like seeing 60% labor, upwards of 50% parts. Sometimes it's difficult to do that. Depending, up here in Canada, we have larger parts costs because many are coming out of the States, and there's duty and freight and things like that. But yes, absolutely, there's margins and targets that we definitely want to be working with our clients to help them reach and achieve. And in some cases, they got to do tweaks and things in their business and their billing and whatnot. And that's part of what we do, aside from just the old traditional financial statement and tax return.
Well, Bryan, I appreciate your time. It's been a pleasure. Just another housekeeping, we will send the slides and recordings. If you have any questions following this, once you re-listen to the recording, look at the slides, please feel free to reach out. We're here to help. Bryan's here to help his firm. So just let us know. But thank you all for tuning in. We really appreciate your engagement, and let us know. Oh, one more question. Oh, thank you. You're welcome. And yeah, so y'all have a great day. Thanks, Bryan.
All right. Thank you.
Bye.
Bye-bye.